The following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes. And now, it's time for the show that breaks down the options market. From unusual activity alerts to market updates and trading strategies. If it involves puts and calls, then our all-star panel will break it down. It's time to hit the Option Block. With your host, Mark Longo from theoptionsinsider.com and co-hosts Mike Tosaw from KnowYourOptionsInc.com and Mark Sebastian from OptionPit.com. The Option Block is brought to you by Options Express. Don't spend time worrying about your broker. At Options Express, security, stability, and account protection are the most important responsibilities to our customers. Secure account access, enhanced financial protection, entrusted with over $7 billion in customer assets, established financial stability. Options Express lets you trade with confidence. Stocks, options, and futures, all in one account. Trade with a specialist. Visit optionsexpress.com/OXradio to open your free account. Options Express is a member of FINRA, SIPC, and NFA.
All right, and welcome once again to the Option Block, your bi-weekly source of options, wit, and wisdom, punctuated by occasional moments of hilarity and sheer nonsense. My name is Mark Longo from the OptionsInsider.com, as well as the Options Insider Radio Network, and I am joined today on the old all-star panel, starting off with Thursday Mike, aka Uncle Mike, aka Mr. Mike Tosaw from the satellite office of Know Your Options Inc. So Uncle Mike, welcome back to the show.
Always happy when it's a Thursday.
So are you now also officially the satellite arm of Sweetman Cherry Group as well?
I don't know what I am. I just do as I'm told.
Just follow orders. Yes, sir.
That's
yes,
right.
sir. Thank you, sir. So are you ready, Uncle Mike, for the Uncle Mike Tosaw extravaganza show?
If that's what you guys want, like I said earlier, if you guys are trying to drive those listeners away, then by gosh, we'll do it. We'll talk about salmon fishing. We'll talk about how to clean a goose after you shoot it. We'll talk football. Or wait, what's this show? Oh, we're gonna talk options. That's right.
That reminds me of an old options radio show I used to do on terrestrial radio here in Chicago, and we were sandwiched between a fishing show and college football. So we had very similar topics, people calling in from those other shows looking for nightcrawler tips and college football tips, and very similar to what an Uncle Mike Tosaw show I think would be.
Well, I think, trading, hunting, and fishing. I mean, what more in football? What more do you need in life? What I thought was I saw something on the internet. It showed a picture of Tim Tebow kneel, and I love him, by the way. I think he's a great guy. But it showed him kneeling down in prayer, saying, "Dear Lord, please help my team to win the Super Bowl next year. I'll do whatever it takes for the Broncos to win. I love my team." And then the picture below it, it shows Peyton Manning coming in. "Here I am, Tim. I'm the answer to your prayers."
Be careful what you wish for, or in that case, perhaps pray for, is the moral of the Tim Tebow story, I suppose. But yes, we are getting listeners writing in saying they want more Uncle Mike. So Uncle Mike, sir, you're going to be front and center for the show. All Uncle Mike all the time. Listeners, prepare yourselves. Go big or go home, as they say. And Uncle Mike is going to go big today. Speaking of big, we also are joined on the panel today by none other than Big Tim Navabi of Options Express fame. Mr. T-Nav, welcome back to the show, sir.
Hi, Mark. How are you?
I am supercalifragilisticexpialidocious today.
That's good. I wanted to say, I think trading and fishing are very, very similar. Right? I mean,
really?
There's a lot of waiting.
You kind of bait the hook and throw it in and see what happens, and a lot of waiting.
Right. You start out with something small, You kind of put it out there. Sometimes there's a lot of weight, sometimes a little weight, but if you get what you want, what comes out is a big thing. So,
well, I think that's probabilities that adds up to too. If you just want to get a crayfish or you want to get some minnows, you can go over to the creek with a plastic cup and you can catch that. So that's kind of like selling something far out of the money. But if you want to catch something big, then yeah, you got to wait for it. So I think the probabilities and option trading and fishing, it all goes hand in hand, Mr. Longo. I've been trying to tell you guys that for years.
I know we're still looking for the sponsors for the Uncle Mike Fishing and Trading Show, but we're shopping that around as we speak. So I'll let you know.
There you go.
I'll let you know when we get the proverbial nibble on that one. And last, the bad fishing puns are just going to go on from here. So prepare yourselves. And last, but certainly not least, a man who knows a bit about a lobster pot or two, or a lobster net, perhaps, or what are they? Lobster pot, where they catch those things, right? Good old Andrew Giovinazzi of Maine fame, also of Option Pit fame. Mr. Giovinazzi, welcome back to the show, sir.
Thank you. Yes, I think they're like the lobster cage. They crawl in and they can't crawl out. It's like a roach motel, but for seaborne roaches, which is what a lobster is.
But for succulent, delicious crustaceans.
Succulent, delicious crustaceans. The Pilgrims used to complain that their people, they were fed too many lobsters because basically they were just crawling up on the beach back then. And they're like, no, don't feed me any more lobster. We can't stand it anymore. That stuff is junk.
Was it devil's food to them or something like that?
I don't know, but there was complaints, I think. Way back in the day. They
were known for their highly cultivated palate, those early Pilgrims.
I think they forgot to crack the shell first before they tried to eat it. I think that was part of the complaint syndrome.
that does
a little joke.
Slightly diminish the succulence of the crustaceans.
Well, who knows? Maybe in 100 years from now, catfish is going to be a main item instead of surf and turf.
There we go. You can only hope.
If we get any more of this global warming stuff that we get going on here right now, it's warm in Maine.
It's warm in Maine. It's 83 degrees in Chicago in March. I went outside for lunch. I threw on a pair of shorts.
I was about to say, well, maybe there is some. The only thing I can think of is, was there any way to stop the polar ice caps from melting 300,000 years ago? No. So I guess we don't have a choice if they decide to, right? That's my
all one big cycle. There we go. Andrew Giovinazzi spouting his very fatalistic view on global events. It's all doomed to failure and melting. All right. And with that extremely uplifting worldview, we're going to dive right into the trading block.
The trading block.
All right, and welcome to the trading block, of course, where we discuss what was trading, what was moving the markets today, and it was a down day on the old street today. S&P closed down about 10 handles to 1392, almost 1393. The NASDAQ down about 12 handles to 3,063, and the good old Dow down about 78 to 1346. Fixed cash trickling to the upside, up about 3% to 15.59 on the day. And a lot of that activity, a lot of that downside was coming from the weight the market was feeling from all of the poor manufacturing results coming out of Germany and France and, of course, China. And we all know whatever happens to China, the rest of the market follows suit. China is, in many ways, the bellwether these days. But I did promise at the top of the show was going to be all Uncle Mike all the time today. So we're going to kick things off, actually, with a name.
With
Apple.
Sorry.
No, actually. No, and not Apple, at least not up front this time. That is usually the Uncle Mike go-to name. But actually one of his other favorites had earnings before the bell this morning. Good old Dollar General, an old Uncle Mike staple from the show many months ago, had some earnings this morning. Apparently the market liked what it saw. The Dollar General closed at 46.14, up about 3% on the day. So some strong upside in Dollar General. Uncle Mike, are you still size long DG?
Well, full disclosure, I've actually never owned it, but I do like going there for whenever I want to get some high-end clothing. So
that's the place to outfit the family and yourself with some fine threads.
Yeah, pretty much. So they need a big and tall Dollar General. I think that might be the next business venture of my life after the once trading is done. Big and tall Dollar General.
I think
so we'll call it $2 General or something like that.
I think between
I
that,
met Mike. He is pretty darn big. I'm like, dude, why are you so big? And then he said, oh, I played football. I'm like, oh, well, that makes sense.
I think between that and your fishing/trading show, you have quite the retirement plan there for you, Uncle Mike. You're all set.
I don't see how I'm not able to rake in the millions with the plans that I have for business. I just don't understand why I'm wasting my time in this trading world when I can go sell big and tall hand-me-down clothes.
Because then you'd have to work for a living.
Oh, okay.
Hand-me-down clothes. I don't know if Dollar General goes so far as for thrift, but it's interesting. Hand-me-down clothes. Well, nonsense aside, Dollar General aside, what were you watching? What action was catching your eye today, Mr. Uncle Monday, Tuesday, Thursday, Mike?
Well, what I really thought was interesting today, we had a flat day. I know that the markets came down, but if you look at the action on the markets today, just watching the 3-minute chart of the E-mini, you see we fell down to about 1382, and then probably about maybe a little over around an hour before the close, we tested that level again, but based upon the open of the market, we ended up positive on the day today. So everything that's going on today is based upon overnight gap down, and buyers came in at the end of the day. If you look at the volumes, we had buyers coming in towards the end of the day. So that was probably one of the main things that caught my eye. And then going down the Uncle Mike laundry list, so to speak, Apple in the strategy block, I'm going to have a strategy on what to do when you're in covered calls and the thing just goes up too doggone quick and you don't necessarily want to get out of it, but you want to keep with it, but yet you're in covered calls, but you want to do something. I'm going to go over some choices with that because let me tell you, Apple's definitely been doing a lot of damage to the BBI lately.
Yeah, you didn't have too much time to roll that 560, did you?
It was like 3 rolls ago.
Oh, I'm behind. I'm last week's shows.
That's why I couldn't make it the last couple of weeks. I've just been rolling Apple all the time. I'm an Apple broker. But yeah, looking at gold and the metals, we've pulled back a bit in gold. But if you look at a chart of GLD, we're around certain levels of support, and I don't know if I would necessarily, if I were flat, I don't know if I would necessarily want to get into gold just now on the short-term side of it. Long term, I still hold my same view of gold as I always have. I'm definitely a bull, but on the short term, the high 150s, low 160s, it's kind of a range of support. And if we break this, then I think 150 is the next level of support. And then that's when I'm going to have to start doing a little bit more damage control than the protective puts, so to speak. But we'll worry about that when the time comes. But for now, I think we're at some pretty attractive levels on GLD anyway. And if we get a little bit of upward momentum, for those of you short-term gold traders out there, it might not be a bad thing to consider.
I'm looking here at the chart of good old GLD, and it seems like the near-term 6-month or so low was about 148 or so back in December. So we're still a wee bit from those, but you're right. It is in a near-term sort of bottoming type trend. If you're one of those folks who buys into those sorts of things, then it might be something that would intrigue you. I prefer the Cornish game hen and banana indicator myself, which is
alienating all of our technical analysts out there, Mr. Mark Longo.
It does. I joke because I always say that it doesn't matter what indicator you follow, as long as it's widely followed, it actually works. So my Cornish game hen and banana, I'm trying to spread the love for that indicator. Once people pick it up on it and it starts getting an adoption rate, I'm telling you, you can make some money off the Cornish game hens.
Every
and
ship
bananas.
at the bottom of the ocean had a chart room. That's all I got to say about this.
There you go. Spoken like an old schooler. I like it, Andrew. I like it. So
now, old ball trader.
So gold, GLD, and Apple and Dollar General were lighting up Uncle Mike's personal tape today. Mr. Andrew, what were you watching today in your own personal tape, aside from getting along size VIX right here?
Exactly. I was not. I actually put the fade on at the end of the day. We closed a lot of short VIX positions this week at Option Pit, and I actually tossed on a little one here at the end of the day before we had a little break, because I am still fading this. So because of, again, all the rowdiness caused by these crappy 2x volatility products that are listed now, of which the TVIX is one, which was down $4 today, supposedly when volatility was supposed to be going up. How about the performance of that product?
What is this TVIX you speak of? I don't know this product. I'm not familiar with this at all. It's not as if we discussed it several weeks ago.
I thought we did, didn't we?
Yes, we did.
Well, today,
that was very subtle humor. So it doesn't work over Skype.
Your surprised face. Just for the buyer beware products, it is a train wreck. Like, it's supposed to be a 2 times future, a leveraged upside future, VIX future product. So VIX takes off, that thing supposedly intraday should move twice as much as the VIX. At one point, the futures are up about $1. This thing, the TVIX, was down $3. And it's an awful product because I don't think it's being managed, obviously, particularly well. They stopped issuing creation units, and they created a big, huge mess where it traded at such a premium to net asset value, it had nowhere to go but down at some point, which I guess is what's happening now. So just for people out there that are looking at leverage products, you got to look real carefully. It's a lot easier just to buy the straight 1-to-1 product. Just buy 2 contracts. Let's make it easy. Okay? Same 1-to-1 contract, buy 2 contracts instead of 1, and you're doubly leveraged. All right? Don't worry about, because you're basically spending money to have somebody else manage the curvature inside the product, which obviously sometimes they're not doing that great of, or they have an outside constraint. I'm going to get off my soapbox, but buyer beware on this stuff. You can trade the good old vanilla volatility products, which are, believe me, which are complex enough, but at least you can get the move you want. So I'm only just going to mention that. That's going to be a blog for me tonight at Option Pit. But I am watching the vol products. I'm watching SPX volatility, again, getting kind of interesting levels in there relative to some very expensive VIX volatility. So there's potential there. So I've just been trading. I had a few different things on this week and just been kind of trading things back and forth. So,
we had this discussion yesterday in one of our other meetings with some other options folk about these levered and constructed products around the various indices and these structured products, and how poorly they are constructed and implemented. And a lot of our listeners of this show would be savvy enough to replicate this on their own. It is a very simple matter of looking through the prospectus of how these products are quote unquote structured, and then replicating it yourself in a much more efficient and cost effective manner. And I'm sure it'll perform better than this thing. This TVIX has just been an interesting story. Of course, listeners, if you missed our show a few weeks ago, we discussed in depth how there was a massive surge, somewhere on the order of high 30s, low 40% of assets into TVIX in the over the course of a few weeks, a very short amount of time. And that massive influx just pretty much destroyed the product. It caused Credit Suisse to shut down new issues of TVIX, and so we had an issue where essentially like a closed-end fund all of a sudden it became, where you essentially had this NAV, or the trading price, disassociating from the NAV of the fund and actually getting bid up because there were too few units around to satisfy the demand. And of course all the tinfoil hat guys came out saying, well, what was behind this? Who was behind this massive influx of funds? And was it something designed to cause this specific decoupling? And was it another company that's behind a competing product, et cetera, et cetera? And so there's been a lot of back and forth on that, which is interesting. And I actually had a chance when I was down at the conference in Boca last week. DeCebo announced some new VIX of VIX products, and they were going on at length about their universe of VIX products they've created, in the ETNs and the ETFs and the various ETPs that have sprung up around the VIX. And they had some guys from Group 1 there who helped them structure these products. And so I just said to them, I said, are you starting to worry now that VIX has become this entity in and of itself, and there's so many products being listed off of it, that it's starting to have more masters than just the good old S&P front month volatility? Now you have all of these other products lurking in the shadows, tugging VIX in different directions based on their paper flow. And in theory, they should, I would think, net out at some reasonable approximation of what vol is. But when you have weird one-off events like this, or perhaps some poorly structured products jumping into the mix, you can really have VIX starting to be pulled in very odd directions that aren't necessarily indicative of what it's supposed to be. Implied vol of the SPX.
Intraday, it's become more the products like the VXX and some of the, like we'll call them the old school structured products from this. There's a lot more intraday volatility than it used to be, and they become much more interesting to trade from in and out. We do. We get a lot of, well, at least we do. I don't know, but there's a lot of new volatility intraday in these things. And one thing we do at Option Pit is we follow every new volatility product that comes out, and the first thing we tell people is, don't be the first guy in the door on these things. Because you don't really know what's going on. And I call these factors mechanical factors, which are actually outside the movement of the stock. So it's like a short squeeze in these things. So there's movement outside of the normal flow of the market that's affecting these prices. I think they're actually kind of destructive in a way. They're almost overdoing it at this point.
Yeah, that was kind of the point I raised, and as expected, they somewhat deflected it at their own briefing. That of course VIX is not being pulled by too many masters, but I kind of just planted that seed there because that is starting to be the impression I'm getting. And by the way, Andrew, it sounds like, is there a dump truck pulling up to your house there or something like that?
I have all the windows open in my office, so I am going to close one. Hold on.
I thought maybe it was the daily lobster delivery you're getting over there. But Tim, and what we of course have to get to you as well, and what you've been seeing. And I know you boys over in OX land.
I'm sorry, that was the lobster truck dumping my daily ration of lobsters on my front yard.
Yes, exactly. You have to go de-shell them and butter them up later, so we won't keep you.
I used to make the kids do that. 4 years old, you're taking the shells off the lobsters.
That's what you learn.
That's the way it ought to be, by gosh.
I like it.
That's what you learn
country, baby.
That's what you learn when you move to Maine, baby. The proper etiquette for lobsters. I'm sure every kid goes to school with their own bib in their back pocket, right? That's just how it's done.
Are you kidding? They have sleeves.
Oh yes, that's true. That's true. Bib is far too
that's what you Chicago folk do. Out in the country, we don't need no stinking bib.
That's what the city folk do when they eat their lobsters. But Tim, I know you guys over at OX, bringing it away from the lobsters for a precious moment. You boys over at OX had some interesting people. People are still sweating out TVIX over there at OX. One of the reasons why we bring it up today. This is not exactly, by any means, a done story. This is still a unfolding and interesting tale, and it seems like some of your folks over there are still getting caught up in the all sorts of machinations going on here at TVIX.
Yeah, a day like today, for example, I like to call it a learning day. Because there's always going to be a day that you think that you learn something new. I mean, whether it's a brand new trader or somebody that's been doing this for 20, 30 years, and at the end of the day, I talk to a customer who is a good customer, meaning that he knows his products, he makes money. He trades a lot. He trades a lot of different things. And, when he called up and he said, what is happening to TVIX? And, what do I do? What's going on? And and essentially kind of we had to give him the same answers that, we've discussed today. Sort of just that, it is what it is. It's being priced at what it's being priced. I mean, they can't go change prices on this. And, essentially you're just seeing, representation of something that's leveraged and poorly managed and, are up against things that they can't control, and this is it. So, when you get a call from, someone that experienced who says, what's happening, it really just, it goes, it shows that everyone is going to learn something at some point, and you have to kind of be ready for it, and I don't think there's anything wrong with that. Because that's, believe me, I mean, is this guy going to go, next week buy some TVIX? I don't think so. I mean, I think he's done, and experience costs a lot. So I think we had this situation, a few years ago with some of the other leveraged products where, you see some of the dangers of the leveraged products, and now all of a sudden, that kind of intersected with the VIX. So, you have the sort of the dangers of the leveraged products, all of a sudden now sort of intersecting with the VIX, and that's where we're at. You're going to learn, not to touch something like this, or if you don't have a full understanding of it, or don't really move it. But it happens to everyone, and I think that's really what's most important, because there are some new customers that will call up and they'll say, I really don't know this. I feel like everyone's against me, but you have to learn at some point.
I hate to sound like, the proverbial grandmother wagging my finger at the listeners and saying, don't do that. But we've been down this road before. You're right, Tim, with the previously leveraged products and the options on the double levered ETFs and all the brouhaha that unfolded there. And we've seen how these products can be structured very poorly, managed very poorly. And so I just take it as a due course now, if I'm even looking at one of these products, that I really dive deep into what the hell the thing actually is. They could say 2x short whatever in the title. That means nothing. You really have to dig into how they're actually implementing that. 9 times out of 10, it is with some sort of option strategy. Usually it's a relatively dubious or poorly managed strategy. And it's just something, if you're relatively savvy, you can do this on your own. You don't need some of these products. And if you are going to get into these, for the love of God, I know it's daunting to look at these hundreds of pages of prospectuses out there, and that's why they do it on purpose, so you don't look at these things. But at least try to find the Cliff Notes version or the abstract, or call your broker and have them walk you through some of the finer points of these products, or maybe they'll refer you to the product team at the brokerage firm who can do that for you. But if you're not, there's no reason to learn with your own money like this. That's just a horribly painful lesson that you shouldn't, unless you paper trading, you shouldn't really be learning on the go, on the fly like that. Yeah.
You brought up grandmother. I like to say, if you can't really explain it to your grandmother, really you shouldn't be trading it. So just kind of had to throw that in there.
Sorry, I was just typing there. Two option pit boys
are
made for each other. I can always, you two of you, I can always tell you're typing. You must use the same keyboard or something, just typing furiously.
Well, we must wear like those metal chainmail gloves when we type. Bang, 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 bang on the keyboard.
All right, and that is going to do it for the old trading block today. And now we're going to roll right into the odd block.
It's time to break down the most interesting, unusual, and downright questionable options activity that's been identified by theoptionsinsider.com. It's time for the Odd Block.
All right, and that fancy little surfing music intro means it's time once again for the Odd Block. This is, of course, as the man said, the portion of the show where we break down the interesting, the unusual, and sometimes the downright dubious, some might say even nefarious options activity that is lighting up the old tape today. And actually, I think this might be a first here on the option block where we're doing a name back to back like this. I can't recall another day where we did the same name in the option block 2 episodes in a row, but we're going back to the land of women's yoga wear. None other than Lulu. And Andrew, if I recall from last episode, you were quite the expert on ladies yoga apparel.
Well, I like to think I'm the expert on the ladies in the yoga apparel. Of course, my wife would laugh furiously at that. But yes, I do understand my yoga apparel. And it was in the Wall Street Journal today, man.
Was it? I missed that today. I was too busy.
It is. They had some pictures of, chicks in yoga apparel.
Too busy doing the old radio today to pick up that old print, that Dead Tree publication there. Of course, I do hear they have it online. I should check it out one of these days.
Yeah, and they have the strategy of how they keep inventory low. They're very customer centric. But again, it's a $10 billion market cap with $700 million in revenues. So
that sounds like an old story.
Lululemon for me will be one trade, right? I'm just going to wait for one trade in this stock where I'm going to get massively backspread and close my eyes for 8 weeks. And I am almost there. Almost there.
It's coming, listeners. It's coming. And Lulu closed today at nearly $75.95, up about 2.5% today. And they did have earnings this morning before the open, so looks like the earnings were favorable for the street. And if you recall on the last episode of the Option Block, previously on the Option Block, we discussed a lot of people coming in last Friday and buying a ton of upside here in Lulu, particularly a massive block of nearly 13,000 of these April 80 calls for about $1.60 a piece. Stock was a wee bit lower than when we talked about this. But now we saw, well, first off, these April 80s are, given the vol implosion we saw today, post-earnings, these April 80s have already come off quite a bit. The vol has come off quite a bit, understandably. These are trading about $1.40 now with the stock several dollars higher. So all those people who write into me all the time asking why you bought a call before earnings and you lost money, you can just look at this example and it will be quite apparent. But we also saw coming into today's session, actually, someone picking up a bullish fly and kind of keeping that hope alive that we saw last week that there's going to be some sizable upside here to come in Lulu. It could be downside, obviously, too, because it is a fly, but a little bit more nuanced position than what we saw last week. People just gobbling up upside any way they could in Lulu. We saw a trader coming in, picking up 3,000 of the April 75 calls and 3,000 of the April 85 calls, and then selling out 6,000 of the April 80 calls, and all of that netted out for 92 cents. So it was a big 3,000 lot bullish fly here on the April 75, 80, 85 strikes on Lulu. Of course, we have a max profit on this guy because it is a $5 fly of $4.08 once you knock off the 92 cents worth of premium. We talk about flies a lot here on this show. We don't have an opportunity to really bring them up in practice and people actually trading these with any significant size and some of these names we're looking at. So it's always fun when we have a chance to show some flies. And there's a guy taking a similar position to what we saw last week, where that guy was betting that the stock was going to go off to the moon north of 80. This guy taking a similar bet that stock's going to rally about to 80, but taking a little bit more nuanced perspective and having a much lower outlay to do it. So Andrew, if you had to compare on your Andrew Savvy scale, this 75, 80, 85 call fly versus that guy just picking up those April 80 flyers, which would be higher on your Savvy scale, sir?
I'm going to have to say the fly is definitely higher on the Savvy scale. They sold the volatility. They got a little long. They put the gamma level, which is the long side, at the right strike. And they're at least at break even right now. So if they got a rally, they could make a little dough on this thing. So I think they definitely much savvier. I mean, the guy that bought those out of the money calls was, he was on a one-way ticket to Palookaville, because he would have needed literally about a 15 to 20% pop in Lululemon to really make that worth the risk. I think the fly guy had a much better chance, even though his premium was only about 70 cents. What is it? About 60 cents less.
Yeah, about 60 cents less.
He had a better shot at actually picking up, the delta on the trade, or having a delta be created on the trade. So that was a guy with a lot of dough out of the guy last week. And yeah, he'll be struggling to make that money.
Because that guy, of course, he only has really that one shot. Those calls have now really deflated post-earnings, so his chances are looking more slim every day. Whereas this, the way he structured this fly, it is a little interesting. You're right. He has the long 75 strike, so he's taking a hit there. But the doubles of the 80s will come back to play and perhaps even offset if not all of it, a good portion of the hit he's taking on the 75s. And you're right, he's getting long deltas here because of it post earnings. So it is an interesting position. I'll have to run through how it looks now with all of these. I haven't had a chance to do that.
I was going to run it in my simulator. That's one thing too at Option Pit when we're out of our trainees and our students, we try to teach them there's different kinds of delta. Not every 20 delta trade is equal. Not every 50 delta trade is equal. You've got to really understand how the delta, that trade is going to change character when you put it on. Because you could be totally right on direction and totally drill yourself on execution, that is exactly what we don't want. And our clients actually, that's what we're here for. But we want to make sure, because a lot of our clients, or most of our clients, are good traders already. They have a good feel for a lot of stuff. We just want to make sure that they can use the option leverage right. So that's a classic where one guy understood it, one guy didn't. I mean, it's about as black and white as you can get on that one.
Yes, exactly. And this is a good one for educational purposes too, throwing that fly in at the levels pre-earnings and then post-earnings, just that 1 day difference. Newcomers and traders can see exactly the impact of the post-earnings deflation, I suppose you can call it, of volatility and how that impacts your position going forward. I think that would be a very helpful teaching tool. Perhaps we'll throw that into the scanner you guys have over there, and we could discuss it at length later.
We could.
All right. And that is going to do it for the old odd block. And now we're going to dive right into the Xpress Block.
The Xpress Block, brought to you by Options Express. Options Express lets you trade where and when you want for every level of trading. From advanced charting, free daily trading ideas, and free educational resources, Options Express is the online broker for all traders. Best of all, Options Express allows you to trade stocks, options, and futures all in a single account on powerful yet easy-to-use trading platforms, including mobile devices. Visit optionsexpress.com/OXradio for your free account. Options Express is a member of FINRA, SIPC, and NFA.
All right, and welcome to the Xpress Block, the portion of the show where Big Tim Navabi takes the reins and I relax with a nice, tasty, clearly Canadian. How about that? A nice, delicious beverage. Haven't had one of those in a long time. Is that even still around? I don't know.
Yeah, I don't know.
That's if Sebastian was here, he would love that late 80s, early 90s reference. But seltzer aside, what is going on in the land of OX, sir? Aside from TVIX lighting up your tape today.
That was just kind of what I wanted to talk about, and I think I kind of said, some of it earlier on that, there are going to be times when you really aren't understanding what's happening. And if you try to force yourself into what's happening rather than protecting your risk, you may never get anywhere. So, I think it just sort of speaks volumes as to, know what you're trading. If something sounds too good to be true, it probably is, and don't expect to call up your broker and say, what's happening? What is this? What do I do? Because we're here to make the transaction happen. We can find the buyer and find the seller and hopefully, have them look each other in the eyes and shake their hands and trade. But I can't sit and explain, this product, this leveraged product, and why it's sort of acting like it's acting, and what your risk is, and what you ought to be looking for as far as reward, or what steps to take off now, what steps to take now that your account's been really damaged. Again, just very important to sort of know what you're trading, and have a plan that if it doesn't go your way, or if something happens that you just can't understand, what's your plan? How are you going to protect yourself?
I'm surprised you say this is a relatively savvy customer. Obviously, we don't want to go too far down the personally identifiable role, but this is a customer that you would think, if he's savvy enough, would have realized earlier that something was amiss with TVIX and probably would have reached out to you earlier. But yeah, you think he would have had this, come to Jesus moment a little earlier in this. It's been about 2 weeks now since this kerfuffle first emerged on the markets and TVIX started going its own way. You think that would have alerted him to something that was up? Was this something that he was trading earlier, or did he get into it in the last couple of weeks because he saw something going on in TVIX and wanted to try to take advantage of it, and his dead got burned?
Yeah, I think that could have been it. I didn't go in detail as far as, researching how long has he had the position or even asking him how long has he had it. He was just really sort of kind of panicked saying, what do I do? And that's really what caught us by surprise. Like, really, you're asking us? Because he's a nice guy. He's a good trader. He's patient with us. He works with us. Yeah, I mean, I'm quite surprised myself.
Yes, this is going back to February 21st, as we're seeing here, so pretty much a month at this point. And I believe this is a done deal. They're definitely not going to issue any more, correct? Or initially, they were saying they were temporarily halting new creations, but it appears now that this is pretty much the end of new creations for TVIX. That's correct, Tim?
That's what it sounds like to me. Yeah, that's what I've gotten to.
There were some.
I can't find anything else that says different. Right. Yeah,
that's the gist I've received as well. Initially it was kind of questionable whether they're going to open it up again. Then it seems like now that it's been a month, it certainly seems like if they were going to do it, they would have done it by now.
And again, and I think also too that sort of there are times when you're just not going to know what is the future of the product, right? I mean, we've all seen one instance like this, like what's going to happen with it tomorrow or the week after, where really no one knows, and I think it just, again, sort of speaks volumes to say, look, if I don't know what's going to be happening in the future with this product, is this something I need to be owning today?
And if you look at this chart, I was looking at this earlier today, and Andrew just brought this up again here in the behind-the-scenes show chat. If you look at this chart of TVIX over the past year, this is not the first time this thing has been moving in some odd directions. It gapped up to 110 back around, I believe that's around the debt downgrade crisis, is it not there? Early October, that seems to be about the right time frame. And so there was apparently some sort of squeeze to the upside in this product as well. So this product has all sorts of has had quite the dubious track record, to say the least. So if you're surprised now that something odd is going on in TVIX, then perhaps you are a little late to the party, shall we say.
Yeah, and I just want to have mention something else quick. We also, again, we had a conversation weeks, maybe even a little bit more months ago, where I had a long conversation with somebody yesterday who was talking about, ways to go long the VIX, be long the VIX to protect his portfolio. And I really, had a long conversation with him, and I kept hammering away that, if you want to protect a portfolio of large blue chip stocks, what's the problem with buying an S&P put? I was really trying to draw that out of him. And I said, but if you think, you can make money on volatility, that's a different story. So it took some time, but I think in the end he sort of understood that, either I move into some sort of product where I may not necessarily understand how to trade, especially if you're talking about, just VIX options and what they're priced off of, and why won't the system allow me to make a calendar spread, to look, I have a large portfolio of blue chip stocks and I'm just looking for protection on this. I remember Mark Sebastian just saying, hey, you can always just go buy an S&P put. So.
Yeah, that's a position we've taken quite a bit on the show, as we tend to prefer the direct protection versus these related tangential, perhaps protective, perhaps doing their own thing type of products. You never really know what you're going to get. Of course, I did have some interesting, like I mentioned on the last show, there were quite a few interesting discussions on that very topic down at the CBOE's Risk Management Conference, where they were comparing and contrasting things like SPX put spreads versus VIX calls and VIX calendars. And the person who put together that presentation, his determination was that his particular style of VIX calendars and rolling them in a certain way, VIX call calendars, dramatically outperformed his S&P downside put spread over the last 6 months or so. So there is some people on the other side. There are some people on the other side who think that the VIX options are perhaps the better hedge, but you really have to structure those correctly. I think just going out and buying a VIX call versus an S&P put or a S&P put spread, I think 9 times out of 10 you're still going to get more direct bang for your buck in most scenarios than the VIX calls. And I think that analysis they did at the RMC, I'll have to go back and read through the panels and the notes again, but I believe his analysis somewhat showed that as well. The VIX calls and the VIX products tend to outperform on those very dramatic days when the market is taking a bath, like on the downgrade day and stuff like that, when VIX is off to the moon. Those are the days when the VIX will outperform. And then if you have a few of those days in your time horizon, net you will outperform the S&P put. But on just about every other given normal market day, the SPX put or the S&P put spread is going to outperform. So it really depends too what your time horizon and what occurs in that time horizon as to which position is preferable. But it still seems like in the vast majority of scenarios outside those extreme quote-unquote black swan type events, I think the S&P direct puts or put spread are going to be the preferable option. All right, and
you have to know how to know how to understand it too. I mean, he could have given a great talk. He could have been right 100%, but again, he's got the numbers, he's got the research, and most people don't. They just want some protection.
Speak for yourself, sir. I have all the research at my fingertips all day long. There is no product at which I am not fully versed at all times. All right. And that is going to do it. With that note of nonsense, that will close out the old Xpress Block. And listeners, I promised you all Uncle Mike all the time on this show, and now we shall deliver with the Strategy Block.
The Strategy Block.
All right, listeners, those gentle tones of strategery, to quote our second removed president of late, those gentle tones mean it's time once again for the Strategy Block, the portion of the show where the man from the mountains holds court on some particular strategy or options topic or note of wit and wisdom. And my little birdie told me, and also it was mentioned at the top of the show, that I do believe you're going to discuss some aspect of Apple. And I believe it is the success story you've had of purchasing downside puts repeatedly, correct?
Absolutely. All the time. We've been in long puts this whole time.
And it's worked out smashingly for you, sir.
It has. I guess I only told you a third of the story, though, of all the positions involved. But yeah, right now, as a lot of our listeners know, we've been putting on collars on Apple for many hundreds of dollars in Apple. I think we started back when it was in the 100s, honestly. We've been doing this for a while. And a question comes up a lot. What do you do when your covered call goes in the money? And I kind of want to just give you an idea of some of the things with which some of the choices that you have, from very basic to most complex. And I'll tell you what we've been doing with Apple and why we've been doing it, what we've been doing with Apple. First thing that you can do once the covered call hits your short strike price. So let's say XYZ stock is at 50, you sold the 55 call, and the stock goes up to 55, and you still have 3 weeks left till expiration. Well, what are some things you can do? Well, the first question that you need to ask yourself is, am I bullish, bearish, or neutral on this stock? If you're neutral, meaning you think the stock's going to stay the same, then you're in a really good position because of the fact that you're now short an at-the-money call option. And because of that fact, you're going to cash in on time decay in possibly one of the most efficient ways that there is. If you're a little bit bearish on it, meaning you think the stock's going to go down, then it doesn't make any sense to stay in it anymore. Granted, you're going to lose a little bit on that short call, but the amount of money that you made on the long stock will outweigh that loss. Now, granted, you're going to have the loss combined with it. It's not going to be quite as clean of a fit from the stock just going from 50 to 55, but you're going to be profitable. And one thing that I promise you, if you ever go to a party and say, I made $1 million trading covered calls, no one's going to say, well, yeah, you had to get out. You were a wimp. You had to get out of the short calls early before expiration. No one's going to say that. I guarantee it. Now, the other question that you need to ask yourself once it's at 55, and this is probably, if the answer is that you are bullish still, once the stock hits 55, that's when you got to get creative. And that there's some choices that you have on this as to what you can do. The first thing that you can do is you can say, all right, you know what? Yes, I'm bullish, but I'm fine just letting myself get called out. I'll wait it out, and then hopefully I can get back in next month. That's one choice that you have. Nothing wrong with that. Next choice that you have, you can say, you know what? I'm just going to take the loss on the covered call, and I'm going to ride this stock higher. You can do that as well. We've done that with Apple several times on this run up. Another choice that you have, you can roll it up for a debit. You can actually buy to close the 55 call and then sell to open the 60 call. Keep it in the same month. We've done that with Apple several times too, and it's worked out well for us because, yes, the stock did continue to go up. Some other things that you can do, you can roll up and out. Now, up and out is probably the last choice of what I would recommend, and we just did that recently with Apple, and I'll explain why in a moment. Rolling up and out means, let's say the stock goes up to 55 and the 55 call for the front month, which is what you're in, is at $1. Rolling up and out would mean go to a 2-month covered call at 60 that's also priced at $1. It wouldn't cost you anything to do it. There's no debits involved. But what you then have the ability to do is have it not cost you anything, have more upside. But the disadvantage of doing that is that you actually have to wait more time until something actually happens. We did that recently with Apple. We did that a couple days ago when it crossed the 600 level. We bought to close the April 600s and then sold to open the July 650s it was actually a little bit of a credit. Now, why did we do that? Like I said, that's typically our last resort whenever doing a covered call. The reason that we did that is very simple. We're out of money. On the way up with a lot of people's accounts, we've been rolling up puts and buying to close covered calls. Apple has gone up at such a rapid rate that we've had to actually do so many debits on the way up, which once again, it's a great problem to have. We've had to do so many debits on the way up that we're starting to get people on margin just because of the fact that we've had to do the debits so much. Now, my personal projection for Apple, and it's been this for a while, has been 700. I think it's going to be at 700 by the end of the year. It's come to 600 a whole lot quicker than I anticipated, which, once again, this is a great problem to have. We have a client with 1,000 shares of Apple. And once again, for him, we just couldn't justify doing any more roll-ups. So we're not big fans of margin at Know Your Options. We'll use it on occasion if it's appropriate, but typically it's not our thing. And if someone's looking to collar a stock, it doesn't make sense to use margin to collar a stock. So the other question would be, well, why didn't you just buy a call in the first place? Well, we got into this stock a long time ago, and there'd be some pretty big tax implications. So we have a lot of very good problems that we're dealing with. And with that, the reason that we are doing the even money or credit rolls is because of that simple reason. Now, if Apple does continue to go up, if it were to go up to 650 tomorrow, I would probably roll up and out to the October 700s tomorrow. Just because of the fact that I'm just going to keep doing that. And eventually we're going to have to pay the piper, meaning eventually if Apple does keep going up, then what we're going to have to do is be out at the January 2014 900 calls or something like that. If that's the case, I'm comfortable with that. And we can work with that. We'll continue to roll up the puts and roll up the covered calls. And eventually it's going to have to sell at some point when you're doing this. And now we're at a phase to where, yeah, Apple it might be, who knows, it might continue to go to 6,000, you never know, but from a realistic standpoint, the money that our clients have been able to make on this, it's at a point where we need to actually stop using the debit so much and look for an exit plan at some point. So with that, those are some choices that you have when the covered call goes a little bit too far in the money. Now, we have used back spreads in the past, but never with Apple. And that is one to grow on.
Thank you for that, Uncle Mike. I'm sure a lot of our listeners are struggling with that same issue right now, is how and when and the best method to continue rolling their Apple short calls and all the other things that go on when Apple just continues to surge off to the races. And I think there's a lot of listeners out there who are feeling your quote-unquote pain, and by which I mean they're lighting their cigars with their 20s, as you have been known to do in the past, sir.
Well, on the other side of that, if Apple does start going down, what I would totally do is roll down and in. So let's say Apple is at 560 tomorrow, then I would look to buy to close the July 650s and then sell to open the April 595s or something along those lines again, because we'd have a bump in volatility, most likely, and we would look to capitalize on it coming back down like that. So you have to do it both ways, and that's what we did with gold last summer. We were able to actually roll down once gold had its big run. We took off the covered calls and just were in protective put mode last summer with gold. And then when it went back down, because of the fact that we were rolling the calls on the way down, for a while, we were actually ahead of GLD, having our collar strategy, because of the pullback and the way that we played it, we were actually ahead of GLD for that same time frame that we were actually in the trade, because of the fact that we were so aggressive and active in rolling the options.
Wise words, sir. And maybe when we have a little more time, maybe on another show, we'll talk about some different mechanisms you use when you're deciding strikes to roll. Is it purely premium based? Is it, do you weigh in your outlook and how the vol is looking on different strikes? Do you in a lot of different ways you can decide where to migrate your liquidity on the strike chain? So maybe we can get into that in a future strategy block.
Would love to talk about it.
All right, sir. Thank you for that. And listeners, you wanted more Uncle Mike. You got it. But now we have to move on and roll right into Around the Block.
Around the Block.
And those car horns and sounds of traffic mean not only is the lobster truck pulling up to Andrew's door yet again, but it's time for Around the Block, where we discuss what's coming up on our own personal trading screens for the next few sessions going into the weekend. And I know a lot of folks have been fixating on oil. I'm sure, Mr. T-Knob, that's been on your trading screen quite a bit as well, given you are quite the oil aficionado these days.
No. I have gotten some phone calls for some bid asks on some 150s going decent a couple of years out. But yeah, other than that, nothing I have expectations on. But, I think the price of oil is definitely something to watch here. It has a lot of people nervous. Gold, I think people are really expecting a move one way or another out of that one. And bonds, same thing. I think people are expecting a move. So that's kind of just what's on my screen. Just going to see where things go.
Andrew, what are you watching?
On the oil? Well, I've got a couple things. So we've taken a little pipe on the USO because I thought, we have this potential Strait of Hormuz, blah, blah, blah. You have these, we'll call them geopolitical issues. And the volatility, let's say the USO is the easiest tradable product for most retail. It definitely is probably one of the stinkiest moving products. So I officially don't like it now. You can tell because I haven't made any money in it. But volatility is basically at year lows, right? So I remember the good old days in like 1991 when we had real good oil scares, volatility exploding all over the place. Here, there's zero demand for options. So I'm trying to think, maybe the world is thinking the Iranians really aren't going to do anything crazy. maybe the fact that they might not be able to export any oil anywhere would put them into such a tailspin they don't want to risk it. I think the world is adjusting pretty fast to the potential of no oil coming out of there. And I think that's what the options are showing. The options are kind of saying, okay, fine, oil's probably $20 too high. That's our Iran premium. And until, a resolution, that's where it stays. So it feels like more like suspended animation to me. So I have the position got switched over to kind of more just long puts, basically. Probably going to roll out till May. That kind of an idea but they're just not, just mostly because the vol's so cheap. That's all I can think to do. And the USO has backed off a little bit from like 41.5, but it's not moving, right? So oil, one thing, it's down a little bit today, but overall it's just not showing any real intraday, day-to-day vol, no realized vol. So that's just to me a translation of nobody gives a damn, right? Normally, people care more about the juice in Lululemon than they do about the vol in USO or in the oil price. I think that's a big deal, right? Because there's potentially tons of money to move into that stuff, and it's not. So it's either the buying opportunity of a century, and I'm looking to re-enter, but I'm waiting just because I want to see an uptick. I want to see something, and I don't think it's worth it. So I like using options to have as a little feeler, like a cat uses whiskers. If I don't see any scratching at all, I'm like, well, and that's basically where I am. So I'm not in a love it or hate it with it. I'm watching it and I'm surprised there isn't more action, but I'm not surprised because the realized volatility for where oil is actually very, very low. There's very little interest considering the potential weight of really what could happen with it. And that's to me the most surprising.
That's not exactly surprising.
That's my take on oil.
Well, the oil interest is surprising. The strange performance in USO is not entirely surprising. We've discussed that on this show many times in the past, and just what a weird beast USO is from many perspectives, and how it's really not it's kind of the only game in town right now if you want to play oil in the securities side outside of trying to dive into the big futures. But it still is very much an imperfect beast, and we've talked numerous times on the show about how the performance is not indicative of what's going on in oil.
Ball with one direction. If you like call spread, put spread type of thing, that it works okay. But as far as like any intraday or any close to close vol, it is just a junk product like that. It's squishy and soft, and I don't like it. So
hey, maybe we'll see.
I even know how it works, and I still don't like it.
Maybe we'll see a massive influx of funds into USO, and this one can shut down as well, and we can have all kinds of interesting chats about what's going on with USO, and Tim can get those panic calls at 2 a.m. from his customers.
It's like the UNG. I had a trade in the way that trades, but I know that trade's crappy, right? The USO trade, let's just call it less crappy, but I assume a certain amount of crappiness.
Just stay out of the leveraged.
So,
good to know you plan for the crappiness ahead of time. So, do you tell your clients to
once
pay?
You understand how a product trades, you take your advantage of it.
So you tell your clients plan for crappiness and then do stuff. That's the mentoring going on over there
exactly.
in Option Pit Land. Plan for crappiness.
I actually use that terminology. They get it.
Okay, plan for crappiness. Okay, now you found the crappiness. Now do stuff. All right, go. Go with God, sir.
Exactly. That is, and people pay us tons for that insight.
I think I just summarized the entire silver course in one sentence right there. No, of course
you did. But we didn't get taken to the hoop on TVIX. So there you go.
There you go. And last but certainly not least, you love him, you want more of him. Good old Uncle Mike Tosaw. Uncle Mike, aside from rolling Apple and planning perhaps some new buying opportunities in GLD, what is catching your eye here, sir, going into the weekend?
13,000, 1,400, 100, 160, and 31. Those numbers, guess the underlyings, and I'll leave it at that.
Well, Dow, obviously. What was the other one? 100
on the S&P 500?
13,000 on the S&P 500, yeah.
Wow.
Oh, 13,000. Oh, sorry. I was having
The leveraged
there.
S&P.
Wow.
The levered S&P.
That's
I
the
have
10x,
that
the
problem.
10x S&P.
All
I don't
leverage
look
all
at
the
the
time.
Dow. Who cares about the Dow? Who cares about the Dow? 13,000. That's 46 points away.
So just there's a lot
By
of
the end of the
numbers.
year?
There's a lot of key numbers that are going on. Just looking at the numbers and seeing where they take us.
So a lot of interesting stuff going on. Of course, VIX is positioning itself a little interestingly going into this week. Oh, not weekend yet. It's Thursday for us, but by the time you hear this, listeners, it will be the weekend or coming up on it. We are seeing VIX get a little bit of juice. You said you're still fading the rally here in terms of vol, Andrew. You're still thinking we have more to go on the downside before we start popping back up again?
Yeah. Did you see the sell-off at the end of the day? It's almost like these guys have to sell more futures. It's crazy. I mean, they sold off really hard at the end of the day. It's like somebody hit the buy program for stocks and then just sold every vol product there was. I mean, at one point, like VXX was up a buck and change today, and they smoked it. So, yeah, I just think more follow through till tomorrow as they mark this stuff down. So we'll see. Looks like because they probably kept things a little bid in the VIX today instead of starting to mark it down. And once the market really started to cool, they started running things a day ahead, pushed the juice down. So we'll probably see a little bit more of that tomorrow. Maybe for a quickie, probably open down low, probably stay there, unless, China stops exporting something again or something like that. But as far as running the sheets going, so you'll probably see a little more follow through on the downside for the vol products. And they'll stick there until, because, there's only so low, they'll let it go over a weekend now. So that's my quickie take on that.
Well, thank you for your quickie take, sir. And with that, we're going to wrap up the Around the Block segment and also this episode of the Option Block. I, of course, want to thank all of my cohorts, my partners in crime, for joining me here on the old All-Star panel today. Starting off with the man from the mountains himself, good old Uncle Mike Tosaw. What is coming up in the land of KYO that may interest and or intrigue our listeners?
Well, Thursday night, the 29th, I'm doing I'm a guest speaking on an Options Express webinar. The Condor flies again. Just exactly what everybody wants to trade in a low volatility environment, a nice iron condor, right? With it, I'm going to be going through a lot of things with just the mechanics of it, ways with which sometimes we do adjustments on them, why you would consider trading one. And if you've never really traded a condor before and you're interested in it, tune on in. It will be interesting.
I'm still waiting for the Trading with Stupid webinar.
One of these days.
I think we had someone write in about stupids. Maybe I'll have to send that question to you for next week's show. We can discuss the genius of trading stupids.
I love it.
All
We
right.
actually had a client that traded Apple stupids.
Oh, well, I guess he's doing all right then. I guess depends which way he did it, but
It was very impressive. That's all I gotta say. The timing was pretty darn good. So, yes,
Well,
he was anything but stupid.
aside from Apple stupids, what is coming up in the land of option pits, sir, that may intrigue our listening audience out there?
Well, we have Mark Sebastian and Russell Rhodes doing the SPX webinar with the Street on Saturday, all-day webinar. You can be in person, basically showing people how to trade it, probably going to touch on stuff like iron condors, things like that, and understanding, again, product knowledge. How does the SPX work, right? And I think that's, for anybody that has an interest, considering the size of the contract, spending a couple $100 on this seminar where you actually understand how the SPX is going to work will go a long way toward learning how to trade the thing. So it will save you at least that much money on not doing something stupid in the SPX. So I would highly recommend that to anybody. And that also, we have a webinar today. We had a little boost from Jim Cramer. Mark did some research for him, so we are doing a follow-up webinar tonight on that. If you go to www.optionpit.com, it is a free webinar. Last night's actually, we filled up in like 5 seconds. So hopefully you can get a spot if you register. Unfortunately, you probably won't be able to register now if you hear this. But it is tonight at 7 o'clock. tonight. And that will, again, trading, understanding how to trade the VIX, how the thing works. So, again, more educational stuff from the option pit.
Yes, and take it from myself, a former degenerate SPX pit trader, that is a unique and bizarre product. So if you can have someone walk you through how to trade it, then by all means do so. It's definitely worth your while to do that. And last but certainly not least, Mr. T-Knob, what is coming up in the land of OX, sir?
We have some free upcoming workshops. There is one in the Chicago area on April 14th, Saturday. That is in Oak Brook. It's at the Hyatt Lodge at McDonald's campus. We also have one on the 24th. That's in Phoenix at the Arizona Grand Resorts. So don't hesitate to contact Options Express so we can give you some more information on that.
And don't forget to call Tim Navabi at 2 o'clock in the morning to ask him his personal insight on the TVIX. He will appreciate it, as will his fiancée. All right, sir. Thank you for that. And of course, we want to thank everyone out there for downloading and streaming and subscribing to the program and making it such a success. And we'll see you next week right here on the Option Block.
Become a part of the Option Block. Just visit www.theoptionsinsider.com/forum to post a question for the hosts. You can also submit questions to twitter.com/optionblock or leave a voicemail at 312-544-9356. Make it interesting and your question just might make it on the air. The Options Block is property of the Options Insider Incorporated. All rights reserved. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.